This is Mark Anthony with Mercury Time Price Analytics. Welcome to our end-of-day futures trading video update for Tuesday, March 3rd. Unbelievable day today, remarkable similarities to yesterday. The way I started off yesterday's video, and not trying to brag at all, but just to make a point. I started yesterday's video by asking the question, if I told you that the trade recommendations that were posted on our Slack channel, our member Slack channel yesterday, booked 165 handles, you would probably think, well, you probably got in this crazy move at the end of the day. We didn't. And if I mentioned to you today that we booked 171 handles and didn't participate in this crazy spike off of the 50 basis point rate cut, well, it was the same thing. I really don't care about catching these goofy moves. In volatile, violent markets like this, to use a baseball metaphor, you choke up on the bat and you try to hit singles. Try to make contact, I should say. And that's what we did. So let's start with last night. Yesterday's day session, you went up here into the above 30.90. Now, what I wanted to see in Globex, because we had this pivot here from the day session, what I wanted to see in Globex was a marginal new high that didn't extend. That's exactly what happened. So when ES came down below this 82, that triggered a short, and it was a nice trade in Globex. And then we put it away for the night. Didn't want to mess with it after that. Well, these important pivot levels, especially these long cycle algo pivots, you see price revisited back and forth. Now, here's what happened into the spike up on the rate cut. Let's take a look at the pivots that we posted for our members last night. You had an extension pivot up here at 31.34. And where did it come? And actually, because these have been some of these have been updated for tonight, here's a screenshot of the pivots that were on there from last night and this morning. So here you go, 31.34.66. Exactly as we put it out for our members last night before the Globex open. So you got this move up. Now, the first indication that something was wrong or not right, however you want to look at it, is how far that came down. Now, we did try a long entry here. We took a long at 31.09, had to stop at 31.02. Now, as I mentioned last night, risk management and trade management are two sides to the same coin. Risk management is going into the trade, how wide a stop are you going to give it, and what is your contract sizing going to be? How many contracts are you going to put on? So if you need to give a stop more room, well, then you can control the risk simply by sizing down your contract. So when I put this trade out, I didn't have a good feeling about it at all because it shouldn't have came down this far. So we put it out as only 1/3 of normal positioning. And that's how you control risk. Now, when it came down and broke the roundy at 3,100, that was a second indication there was a problem. When it couldn't maintain this pivot from yesterday, 3 strikes and you're out. The market, look, the Fed did what they felt they needed to do. And I'm not going to get into Fed policy, right or wrong. That doesn't make you any money. But the market reaction, and that's all that's important. But the market reaction was unfavorable. Why? Because you had an intermeeting 50 basis point cut, and that indicates to the market that there's something very wrong. And so sure, you got the knee-jerk reaction up, but I didn't care about it. When this bar started to run, we could have jumped in. I mean, who knows where you would have gotten filled. At that point, the market's moving so fast, you can't even trust the prices on your screen. But I saw this developing, and you could see on the news the headline, and we just let it go. Because you don't have to swing for the fences in a market that's volatile like this. If you're right, you could hit a home run. If you're wrong, then you're getting carried out, and you're trying to spend the rest of the day trying to make up for it, maybe even the rest of the week. So I just let these things go, these crazy impulse moves in a violent market. I don't care about them. And so that trade was the only losing trade today. 7 handles on 1/3 of a normal position size. So knowing that this was an important level that we traded off of last night in Globex, this 82, When it came back down, that's your short. And you put the trade on in something divisible by 3, or at the very least something divisible by 2, so that you can take those contracts off in steps. And so the whole idea is, when you get in the trade, as soon as the trade starts going your way, and typically you're looking at 3 or 4 on your first third, but the whole idea is you want to get risk out of the trade as soon as possible. So once you get your first third of the trade out, then you look for where you want to take the middle. And then at that point, you just adjust the stop down. You don't try and pick a bottom. You don't try and get every inch out of the move. You drive yourself crazy doing that. So you just move the stops down. And so at the end of the day, this says 175 handles. It was 171. It's off by 4. But you can see this entry that at the end of the day at 37. Now, let me show you why this level was important. We put out some specific algo pivots in the evening before Globex. We also put out some specific algo pivots in the morning before the open. But we knew that area between 30.23 and 30.39 were going to be important, because look at all these pivots: 30.23, 30.35, 30.27, 30.32, 30.33. So anytime you get a cluster of algorithmic pivots in a particular area like this, that's going to be important. And it's important if you can't hold it. Now, a couple other pivots we have this single daily bull bear pivot. Comes out every morning about 8 o'clock Eastern time. It's one of the first things we do. And you're probably wondering, if you haven't seen our videos before, well, how can you trade off of pivots that are released before the market even opens? Because these aren't based on price, they're based on time price algorithms. They have to be run at certain times a day based on certain length time cycles. And there has never been a day, this methodology, I think I started using this about 2 months ago. There has never been a trading day where the single daily bull bear pivot hasn't been very, very important. So this is at 57. You break that, then you start coming down into these pivots here, clustered between 23 and 39. And when they can't hold, especially off this crazy move here, well, this is what gave you this 115 trade entry. A move down in 337 is your entry. So what you do is, and we took the first third very quickly, only 3 handles, because I wanted to get risk out of the trade as quick as possible, because you're trading 100 handles off the high. So you get some risk out of the trade, you adjust the stop. Then you look for a place to take your middle, and you can see all the time, 1, 2, 3, 4 times. And we ended up booking 21 handles on the runner, 34 on the trade. Now, here's a long entry towards the end of the day. Now, let me go back to the chart and show you what set this up. I really was hoping we'd get a move today down into 29.60, because there were a number of key pivots. Our X5 pivots are very long cycle. These are institutional algos right here. So are the midday pivots. So is the algo daily bull bear pivot. But these X5 pivots are really important. And as you can imagine, there's 5 of them. Well, we had 2 of them at the same price. The X5 pivot from right here, and the X4 pivot right at that same price. Well, we didn't get this move down into 60. So when it came down into the low 70s, 72, 73, then we watched it. Now these are longer cycle bars than what you have over here. So you come down in here, and it doesn't break, doesn't break, doesn't break. Well, after this second bar, then I zoom into 3-minute bars, and we can see exactly where this thing wanted to hold. So, you don't try and bottom tick this. You wait to see if it's going to hold, and then you zoom into the lower time frame charts, like a 3-minute chart, and that's what triggered this long at 29.88. Notice we didn't try and bottom tick this down at 72, because we didn't know whether it was going to go down to 60. But it moved so fast that the first piece of it was 11. Now, I talked about position sizing. Normally we try and trade in something divisible by 3. So that way you can take your first third, then your middle, and then your last third is the runner. Well, because of the risk, we sized this way down to something, it was 1/3 of a position. But let's say, for example, a typical position, 3/3 or full position is, say, 3 E-minis. Well, if you size it down to 1/3 and you put on 1 E-mini, you can't subdivide that. Well, because you got the micros now, you can. So in that case, instead of putting on 1 E-mini, you can put on 9 or 10, whatever, micros. But in that case, it was 10 micros. And so you get 11 handles on the first piece. Now you only have 1 to work with. So what do you do then? Well, just like we didn't try and bottom tick the low, we're not going to try and pick the spot where we think it's not going to go any further. So look at how many times we adjusted the stop. You had your initial stop, and then 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, and we were stopped out at 27. So 39 handles on a runner, that's 50 handles. Now I know a handle is a full E-mini, but you're simply sizing your contracts down in order to manage risk. And because of the amount of movement in this tape, you can size your positioning down and still get a nice move out of it. Now, I want to show you this chart here. And I took some of the pivots off just to give you a little more clarity so you can see the key pivots. This was last night's upper extension at 34.66. About as accurate as it gets. This is this morning's algo bull bear pivot at 57. This is today's midday pivot. These come out between 12:15 and 12:30. 42. And look at how precisely it trades. Right down into that to the tick. Right back up here almost to the tick. And then when it comes down and it can't hold that, well, then you get your short entry. Here's today's Mercury band lower level at 01. And down here, this was the midday pivot from yesterday. So again, you don't try and hit home runs in this kind of market. To use that same metaphor earlier, a baseball metaphor, you choke up on the bat and you try and make contact. Because when you're getting a market that's moving around this much, you don't need to worry about getting this goofy move here. You don't just throw on a trade when you see this extension, because, well, what if it went up 30 handles and right back down? So you can't try and get in on that stuff, because more often than not you're going to get burned, and that's gambling. Well, when you're trading off precision algorithms, then you have probabilities in your favor where you can manage risk and manage the trade, and it's not any more complicated than that. So that's going to be the wrap for today. If you haven't been to our website, it's mercurysignals.com. And just punch that into your browser, and that'll take you to our website. Now we've got 2 primary systems. We got the system that we talked about tonight, the ES and NQ system, and then we've got a bonds crude oil system. They used to be 2 separate prices. Now we combine them, and the price only went up marginally from what we charged for each of these separately. So if you're just an ES trader and you don't trade bonds or crude oil, that's fine. But I guarantee you that having bonds and crude oil on a chart that you can see moving all day long, like this live chart does that we provide for our subscribers, you would have both of these. You'd have the ESNQ, and then you would have a separate live chart for bonds. And all you need to do that, we run this through Zoom so you can see it on your computer, tablet, or phone. And all you need is a free Zoom account. And in order to see 2 live charts at the same time, you simply need to have 2 different email addresses. So you can have 2 Gmail addresses, an Outlook address, a Gmail, whatever. And that way, as a subscriber, you can see both of these. But it is so important because, look, for months, the bond market was telling you one story, and the equity markets were telling you another. Well, guess what? Bonds are going to be right eventually 10 times out of 10. And so it's important, even if you don't trade bonds, to be watching bonds to give you cues for trading ES and NQ. And that's going to be a wrap for this evening. We thank you so much. If you're trading these markets, please manage your risk, manage your position sizing. Don't look for home runs. Look for reliable setups against reliable pivot levels, and then just manage the trade. So thank you so much for being here. God bless you. God bless your family. And we hope to see you again soon.